Hey there. For beginning, myself and Paul just want to remind you that everything discussed here isn't a substitute for formal investment advice and does not represent the formal perspectives of Aquarium Investments. The content of discussion will hopefully interest you, entertain, and supplement your own perspective, but it's important that you conduct your own research or speak formally to a financial advisor before taking any risk with your money. Having said all that, we hope you enjoy the discussion and let's dive in. Hello, how are you?
Hello, Cormac. How are you?
I'm good. I'm good. It's exciting that we're finally getting around to this.
Yeah, we're finally doing it. It took us some time, right?
I know. I have friends who've been asking me about this podcast for a few months now, and they've been wondering. They're saying when is it happening, and I've always been saying, "Oh yeah, yeah, we've got it coming in the next 2 or 3 weeks." And here we are, 3 months later, I think. So yeah, finally happening.
Yeah. Okay. So maybe we should start off with introductions, right? Maybe you start first.
Yeah. So well, I'm Cormac, and I have no formal background in financial markets or trading, but I have a long time interest. My background is I'm a mechanical engineer by profession and worked in the well, studied in computational fluid dynamics, so the highly nerdy and analytical area of mechanical engineering. And then since then, I've been working professionally as a mechanical engineer in construction in Ireland. It seems that anyone that's an engineer in Ireland ends up either in construction or biomed or pharma or software engineering. So I was in construction for about 5 years, and then I stopped working in that towards the end of COVID. Everyone was talking about burnout, and I think I fell into that trap as well, just working from home for a long time and quit after that, took some time off. And since then, I've been pivoting, I guess you'd call it, into the field of data science, just because that kind of inherent analytical nerdiness I have is translated into that area. And I've been studying that for about a year, and it's fascinating subject, especially with all the going ons in the world with AI and machine learning and big data and all this stuff. So yeah, I've been working at that now for about a year and studying that. And yeah, if there's anyone out there that is looking for an up and coming data scientist, come talk to me after these podcasts.
Yeah, I'm sure they
Yeah,
will. I'm
yeah, I'm
sure
sure
they
they
will.
will. Yeah, until they hear me talk too much, and then they'll be like they've heard enough of this guy. You know.
Yeah, that's my problem typically as well. Okay, so I'm Paul. I guess my field of expertise is finance. I worked in a bunch of kind of regional banks here in Latvia, and for more than 10 years now, I've been a partner in this asset management business, MiFID licensed, where I'm partners with your father, Michael Bourke. And yeah, so overall, I guess I've been trading and managing money for more than 20 years. Mainly, these days, it's mainly, high nets and corporates that we deal with. But in my early days, I was trading a lot of FX, like interbank FX, foreign exchange, meaning, margin trading, things like that. Then I gradually moved into bond trading, derivatives, basically all types of markets. So I guess I have a pretty broad understanding of it all. Yeah. So I
Yeah, very
guess.
storied background, right, Paul?
Well, I could go on and on. I have to keep it short, right? So I don't want this to be about me. I want this to be about markets and, hot topics like AI. I guess the main reason for doing this podcast thing is to bring our view of the markets and how we solve these problems to a wider audience, an English-speaking audience in particular. We've discussed this with your father a lot, and we've always thought of ways of providing our services in Dublin. And I guess this is our first step in this direction. I do some market commentary in Russian on a regular basis, and I always found it to be a very useful informational tool, but also kind of an introduction that is kind of humble, but also useful. So we'll see if this works. And, since it's our kind of trial run, we won't be marketing it a lot, and basically we'll just send it to our circle of friends and partners. And we'd appreciate your feedback, because if it's too long, if it's boring, if it needs changed, we would really appreciate your thoughts on this, whoever is listening, right? Do you
Yeah.
agree,
I
Cormac?
agree. I agree. Yeah, absolutely. Yeah. The people that are going to be soft in their feedback, the people that we're going to like the feedback from, that's who we got to send it to, you know?
So confirmation bias straight away.
Exactly. Exactly. Yeah.
Very
Yeah.
good.
Yeah.
Let's do that then.
Yeah.
So your father and my wife, that's the audience.
Yeah. Yeah. And some very, very close friends of mine.
Okay, we'll see. Okay, so I wanted to say that the timing of doing this is actually very good, despite us postponing it a few times. But I think it's a really interesting moment for the markets, for monetary policy. All sorts of political stuff is going on, elections and stuff like that. So it's a very good time to discuss these things because, from my experience, people are very narrow-minded when it comes to asset allocation, given what's going on, and there are a lot of things that are breaking down, the kind of correlations that worked for, I don't know, decades. They're not working anymore. And a lot of people just ignore it or they are not aware of it. So I think it's a great moment. And basically, the reason why is because we are on the verge of an easing cycle in US, but also globally. We have all types of curves speaking, so to say, primarily in interest rates, but also in things like, oil and other commodity markets. I think we're seeing a bit of an obvious kind of economic slowdown in data. It's not awful, but it's getting worrisome. And also valuations, if we're talking about US stock markets, they're pretty high. So and somewhat and the composition of the indices is somewhat concentrated.
And Paul,
So
you think this is more pronounced now than before? Is it because it's been funny, just anecdotally, I've had, again, I've mentioned my friends, I've had friends in Ireland here, looking at buying houses and doing things like that, and there's been this kind of constant talk, as there always is, about oh, we're going into a recession, we're going into a recession. And even myself, I was, for a while there, I was saying, how are things going in Ireland or even Europe, and are things going to slow down? Are prices and things going to come down? And you know what? It hasn't really in Ireland anyway. So is it that you think it's more pronounced now in the data and it's looking like something is coming? Is that your perspective?
I'm not a great expert on Irish economic data, so
Yeah,
I'll
even
probably have
apart
to.
from Ireland, but like, Ireland kind of small fish, big pond always, in terms of how the global market moves, and when things happen in the States and so on, we kind of get the wash down, and same across Europe. So I guess
Hmm.
I meant more on a more macro broad scale.
Yeah, so look, it's every time we're building up to an economic slowdown, there's always this debate of whether, recession is around the corner or and what does it mean, and how deep it will be. And there's always this kind of wall of worry, I guess. I think we're pretty close to recession. We're not there yet. But, with recessions and economic data, the problem is data gets revised. Like you would get, for instance, you would get a reading on GDP that would be positive, and then they do like second reading, third reading, and then the final kind of data point. and it gets revised, right? So you could start off with a positive number and you could end up with a negative number. So typically recessions, approved formally well into like the time passes, right? And you realize that you have been in recession for a while at the moment when it's actually confirmed. So it's a tricky question. In terms of property and real estate and buying flats or houses, I think it's a separate topic
Mm.
because it's like recession doesn't necessarily mean that house prices are going down, for instance. If you Because it's a very unique type of asset, it doesn't really correlate with anything else because it's a natural FX hedge, so if a currency is changed, for instance, your square meters stay the same, you just price it in a different currency, so you're kind of protected from these weird debasement things. And I think it's also reflective of the loss of purchasing power of a currency. So, if there's more currency being printed, it's the chances are house prices are going to go up. So it's a tricky question. I would say there are reasons to think recession is close, especially in US, because of what we see in interest rates. The fact that we're in September and there's like 100% chance that the Federal Reserve will cut rates in a week or so. And, for me, it's an admission of problems, economic problems, because why would you do it otherwise? It means that the economy needs stimulation in one way or another. And I think that the fact that we have a steepener when longer term rates are becoming higher than the short term rates, it's a clear indicator of an incoming recession, at least in a historical sense,
Can you
right?
can you just explain to me from my understanding there the steepener, the term steepener used there because I'm not familiar with that. What do you mean by that?
Yeah, so it's just the movement of relative interest rates on the time curve. So the Fed rate, for instance, if we're talking about US, the Fed rate is the shortest rate, right? It's the one determined by the central bank, by the central bank, and it basically means the rate today, an overnight rate for today. I can actually show you a chart. It's the first one where we have 210 steepener and GDP. So the blue line is GDP, and this is US GDP, and it's a year-on-year GDP. And the red line or orange line is the steepener, right? So it's the difference between yield on a 2-year bond and a 10-year bond. When this line goes up, it means that that's the steepener, right? And I have arrows showing the magnitude of this steepening kind of thing. And it means that short-term rates are lower than the 10-year rate, right? So, and if you look at it carefully at the chart, you'll see that this happens in recessionary times. I have like, what, 5 arrows, right? Showing one is from the 1980, 190, 2000, 2008, and 2020, the COVID stuff.
Yeah, this latest
Uh,
one is this gray arrow. That's what you're talking about.
yeah,
Yeah.
yeah. And, every time there is a recession or an economic slowdown, this relationship changes. It goes from inversion when the curve is the other way around, when longer term yields are lower than the short term ones. And it kind of reverses and kind of normalizes. And basically, when this happens and when it happens aggressively, like it happens now, if you look at the very kind of bottom right part of the orange line, right, you'll see that it's been moving up into positive territory quite aggressively, quite fast. It's one of those things that kind of indicate historically, again, maybe it will be different this time, but historically, it indicates that the slowdown is very, very near. So we're talking
Okay.
months. So we're talking months rather than years. Yeah. So I would say this one, coupled with the actual decision by the Federal Reserve that is coming to cut rates, I think it's pretty indicative of recession. Another
Yeah,
thing,
you can definitely see, you can definitely see the pattern that you're talking about when you look at this graph, it's an
yeah.
interesting one to observe even because it's like this when we're talking about slowdown and recessions and so on, it is like it's always in the circles that I mix in, it's very word of mouth, and people, in Ireland we say, kind of wink and nod, and people say there's a recession coming, but like, to see these patterns in this graph that you're showing is it's pretty interesting, yeah.
Yeah, it's one of those things. You just have to like if you're into macro and the way these interrelations work, it's kind of natural. But if you're not doing this, how would you know, right? You have to kind of study it a little bit. I think another reason to be worried about an economic slowdown is the labor market in US. You can't really, and you can look at chart number 10, which shows the deterioration of labor data. It's the economic surprise of the labor data. Because you can't seriously talk about recession without the weakness in the labor market. It has to kind of go hand in hand. It's not just the GDP. So you could have like 2 quarters of negative GDP, and we actually had it, I think, in 23, if I'm not wrong. But the labor market stayed steady. So you couldn't call it a recession, really, not in your technical terms anyway. But once the labor market goes, I think it's a very, very clear sign of an economic slowdown, because it means that the companies are not hiring as much, or maybe letting people go. And we just had a massive revision of non-farm payrolls, which is like the go-to piece of data for American employment. And they revised it down, less jobs by something like 800,000 jobs, right? So, and by the way, this is another worry. Like when you get these downward revisions of past data, it's also indicative of, problems in economics on kind of a very basic level. So
Yeah,
a lot of
it's like nearly overestimating where you are, or assuming you're in a better position that you are, and then
exactly.
and then suddenly saying, "Uh-oh, we're not quite as comfortable as we thought before," right?
Exactly, exactly. It's like admitting the truth, it just like you can't go and the reason for this, especially in the labor market, is because there are all sorts of adjustments in data. And I don't want to get too technical, and I don't want to talk about econometrics too much, but basically they adjust the data, they kind of massage the data. And for instance, in the non-farm payrolls report, they use this birth-death model, which just assumes that jobs are being created, right, and new businesses are being created or otherwise. And it's a valid assumption in a growing economy. Like if GDP is positive, it's natural to assume that new businesses will kind of appear. But then you have to realign it with actual data, factual data, and that's when the revisions come. And it actually applies to all sets of data. So GDP can be revised, labor data, I mean, all of it. So, I would say there are a lot of reasons to kind of wonder, at least, if recession is close. Europe has its own set of problems. I think they're different in many, many ways. But given the importance of US and US liquidity, I guess it's difficult to see, Europe doing very well while US is not doing as well. I don't think it's very likely. It could happen, but it's not in current situation anyway. So yeah, it's a very interesting time to talk about this, and it's important to know these things. And you know, when people talk to me about markets, and I actually asked myself, like, we decided that I'm going to talk about markets, and I gave it some thoughts, and I think it's important to clarify which markets, you know, because typically when people ask me about markets, they often mean US stock markets or maybe US bond markets. And I mean, it's for good reason. They're some of the biggest in the world in terms of size and liquidity. However, for someone like me, markets has a broader meaning, you know. And when I think about markets, I think about foreign exchange, commodities, equities in a global sense, bonds in a global sense. And I try to look at these things and get an idea of how these different markets interrelate and whether they correlate, and or whether these correlations are breaking and for what reason, you know.
Mm.
So yeah, and I think, and I basically asked myself, like, what if I'm not concentrating on particular market like US stock indices, for instance, like what is the approach for this particular conversation? And I asked myself, what are the three most important things that I look at right now? You know, and basically there are three, and I'll just say them out loud. I think first one is FX, foreign exchange, and FX volatility, but also volatility in a general sense for all market classes and assets. And when I say foreign exchange, for me, it's a very broad subject because it obviously includes the dollar and major cross rates, but it also includes stuff like gold. You know, for me, gold is a currency. I don't treat it as a commodity. I think it's a currency and it behaves like a currency. And especially these days, it behaves like that. I think the second one is the steepener that we kind of covered a little bit. And I mentioned that it's a great tool for turning points, and it's a sign of economic troubles ahead. And I think you have to kind of look at it and consider it at least. And it has implications, and the easing cycle has implications. Some of them are obvious, like yields drop, bond prices go up. It's a mathematical equation, basically. But it's not just the U.S. sovereign market, because U.S. sovereign rates, they serve as a magnet for other bond classes. So corporate debt, emerging market debt, denominated in dollars, obviously. It kind of lifts all the boats. So it actually means that the bond market is a pretty good place to be in right now, especially the shorter end of the curve, and we can talk about that if you want. And I think as I mentioned, I think the turn in rates itself is a sign of economic troubles. You know, central banks don't do these things just because they feel like it. You know, there are good reasons for them to do it. And the third thing that I focus on is the fiscal push in the US. You know, we have presidential elections in US. They're fighting each other and trying to be the bigger populist these days, right? So, and I think it's important because there's no question that liquidity will be provided. You know, whoever is winning, whoever wins, they will pursue these fiscal spending programs. But it will be interesting to see in which form this money actually gets into the economy.
Yeah, is your thoughts on that? It depends on who gets in, or is that what you're kind of touching on there? That it could be done in two different ways? Yeah.
Well, it's yeah, like the form depends. Like for instance, Trump is talking about tax cuts. Harris is talking about rate tax hikes, right? So that's completely different. I think whoever wins will have to do it. It's just what do they concentrate on? How do they provide this? So, Trump is talking about oil and about oil production and how he wants, oil prices to go down. I'm not sure he can do it, but, he wants it. Harris is not a big fan of big oil. I'm guessing here. I don't know, but
I think you're
that's
probably guessing right there.
probably, yeah.
Probably.
It's actually, I don't think it makes much sense to hate oil, but that's probably another
That's a
topic.
whole ideological discussion you go into there, you know.
I would say it's an economic discussion, but people shift it into this, ideological.
Yeah, perhaps for a different podcast, right?
Yeah, yeah. Oil is a separate subject, but it's important, right? So it's just one example of how they could address this. So, they could probably subsidize different sections of the economy, maybe. But what interests me mostly is whether it's going to be limited to, these kind of taxation ideas, or is it going to be subsidies, or is it going to be 2020 style when they just gave money to everyone? So so we'll have to see, but it's super important. And it's the elections, what, 2 months away, so we'll know fairly soon. And maybe next time we do it, we can discuss this in more detail. Right now, it's just like pondering, you
I
don't
know it's
know.
speculation at the moment
Kind
as to
of,
which
yeah,
way it's
yeah,
going to
yeah.
go. Yeah, yeah.
Yeah. But if I had to choose one of the three, I would choose a fix, because I think it's one of those things that people kind of ignore, and I guess I've been scarred by my experience as an FX trader, because I've traded it like daily, and it kind of influenced the way I think. But, these days, the dollar is central to everything, and whatever happens to it kind of influences other asset classes too. So it's one thing, and the reason for this, the biggest reason for this is because foreigners own a lot of US assets, right? So, trillions and trillions. So it's one thing when dollar is in, it's one thing when we are in this strong dollar environment, and people are motivated to kind of invest in US because they get this carry type of thing. They get appreciation in their base currency as opposed to dollar, but they also get some gains in the actual markets. So, prices of stocks go up, but also dollar goes up against euro, say, for us as Europeans. And it's another environment when dollar is weak. So it's the other way around. You're not motivated to invest, or at least less motivated to invest in US. And, if the dollar drops a lot, and by a lot, I mean 20% or 30% or something like that, it's very likely to influence capital flows out of US, And another thing about FX, I mentioned volatility. Like the last 10 years, we've been in a very, very low volatility kind of setting as opposed to previous years. And I think people stopped thinking about this risk. I encounter this all the time. People ask me, well, should I hold my capital in dollars or euros? And what's my base? And a lot of the times they just ignore it. That they don't think in these terms. And I think it will be the biggest show on earth in terms of what's going to happen. And it's definitely
So
going
when
to
you mean
influence.
ignored, it's like, you know, people have their positions in something, and it might be a US dollar position. And you're saying that they're looking at their position and they're saying, well, for example's sake, this company A that I have is maybe not performing as well, or it could perform better, and they're looking only at the micro performance, I guess. I don't know if maybe there's better terminology for this, but they're only looking at the direct performance of the company or the position rather than considering the the US dollar versus, euro versus whatever end of the equation. Is that kind of what you're touching on there?
Kind of, yes. So, like with a specific stock, you might not have options, right? So, for instance, we're planning to talk about AI and all this chip stuff. So, if you want to hold NVIDIA, for instance, you don't have an alternative, right? They're the only ones making those chips on that scale, and you kind of have to go there. But if you're talking about an index, say you're invested in S&P or Nasdaq or something like that, it's not company specific. It's a broad kind of basket of stocks, pretty much.
Mm.
And for example, if S&P is just flat, say it's not going up and it's not going down, it's just like staying within a range of, I don't know, 10% or something like that. And you are in Europe and your base is euros because you spend in euros, your mortgage is in euros, you get your salary in euros, you kind of have to count in euros. And the dollar falls, despite the fact that index is flat, it didn't change, the price didn't change, you could be losing money on a factual basis, and the more you
Probably
lose,
very, very difficult, not to cut across you, Paul, sorry.
no worries.
Probably quite difficult for a lot of people to think on that scale, right? Especially for retail traders and for people, the people out there that have a semi-passive, semi-active interest in the markets and they're trying to understand what's going to go up or what's going to go down. It's probably quite hard to think in that scale, saying, I think the US is going up versus the euro or the euro or vice versa, and make judgments on that basis, right? It's probably quite hard to consider that for a lot of people, unless you're in the business and you're working on it like you are.
Yeah, I guess I don't find it hard. I mean,
Yeah.
in mathematical terms, it's pretty straightforward. These are just cross rates, you basically just use arithmetic to arrive at whatever. But it's I often say that people don't get a fix. There's something about foreign exchange that is anti-human, it's somewhat, for some reason, it's hard to get your head around it. Like I said, my early days in finance were in foreign exchange, so it's easy for me. And I guess it could be hard to get your head around it, but it doesn't mean you don't have to think about it because it could be critical. I actually think it will be critical. We like in our business, in our asset management business, we have this exercise that I call scoping, and it's basically like someone with an existing portfolio would come to me and say, well, what do you think? And I go through the portfolio and I try to kind of find maybe risks that are not accounted for and maybe some potential problems. And all I see, irrespective of where the guy comes from, the girl comes from, all I see is like this typical allocation to US bonds and US stocks. And when I ask them, well, have you considered a fixed risk? They don't know what I'm talking about, you know.
Okay.
And these are not your kind of average folk, right? It's not your guy with a little bit of money that doesn't want to think about it. These are wealthy people with a lot of capital, So I wouldn't say it's just this misunderstanding of this is limited to, common folk or
Yeah, it's
whatever.
it's it's kind of inhuman, is what you're saying. Like it's maybe lack people don't have insight or don't fully appreciate it or grasp it is kind of what you're
Yeah,
saying. Yeah.
yeah, it's kind of what I'm saying. And I think the reason for this is because these problems have been forgotten. Because like if you look at euro dollar, it's been pretty stable, right? It didn't change much over the past 10 years. It kind of stayed around 110, 115, and people just forget that this risk exists. I think that's the problem. But it's critical now because, like I said, the fiscal push is coming in US and it will be bigger than anywhere else. And I think it will, I actually think it will be massive, right? So it will influence the amount of dollars in the system for sure. So, as you get more paper money, other things go up in price, right? Coming back to the property stuff, the real estate stuff. Um, so it's a good time to start thinking about it. That's my I guess that's my advice, right?
That's the long and short of it. The too long didn't read the whole story version. It's a good time to start thinking about these things.
Yeah, yeah, it is. And like if you look at August, for instance, we had this wobble in the markets, right? You saw some equity markets fall, S&P and stuff like this. And the reason for this was what was going on in Japan. And Japan is a unique kind of country. It's a country that holds the biggest proportion of U.S. debt, U.S. treasuries. Well, at least from the point of view of foreign holders. So their holdings are bigger than China's holdings, for instance. And another thing about Japan that is unique is their net investment position. And it's a positive net investment position. I'm not sure about the number, but I think it's like 4.5 trillion. And it basically, this net positive investment position, it means that Japanese own a lot more of foreign assets than foreigners own Japanese assets. So when yen got super weak, it kind of motivated Japanese corporates and households to repatriate yen, right? And to do that, they have to sell the dollars, they have to sell their assets and then sell their dollars for yen, get it back and reinvest. And that was the reason why the US stock market kind of was wobbly. So, and I think it's like one of the first cracks, obvious ones, right? And I think we'll see more and more of this stuff. So yeah, it's a good time to start thinking about this for sure. If you're exposed to US markets, you have to think about it. I mean, you can always hedge it, right? You can always take the other side and hedge that risk out. But then again, are people doing it? No, not really. From my experience, they don't. They just leave it as it is. Yeah, and I think it's I think it's worth considering
Yeah,
this.
there's probably, I know we keep mentioning that we're planning on talking about AI in this discussion, but it's probably there's been so much I mean you turn on CNBC or Bloomberg or something and it's every day there's so much hype in the markets and a lot of it may be being generated by tech talk and things like that, but I guess what you're explaining here is some decent and solid reasons, and looking at your charts as well for why, you know, we should have a little bit of caution. And I guess what you're touching on there is with Japan is you're kind of saying it's having my notes here, proverbial canary in the coal mine, I think is what you called it.
Yeah, not me. It's a well-known saying.
Okay. Yeah. It's interesting, all right. Yeah.
Well, I think we should talk about AI, and maybe it's a good point to do this. But my point is just to come back briefly, is that, you could have this amazing stock, right, that is going up, but there are other factors apart from what the company is doing and how well it's performing. And we're at this stage where even the good stuff could be, sold off for reasons that have nothing to do with the company, for just because the dollar is falling or relative rates are kind of interchanging or some correlations break. And that's another thing that I wanted to point out before we move on to AI. I think one critical thing, and I'll show a chart on this. Yeah, it's chart number 4. I think, and it's basically gold in dollar terms and US real rates. So basically in 22, this correlation broke. Typically what you would see is when real rates go up, it means that you get some yield on a real basis, right? So it means that the interest rate, the prevailing interest rate, is larger than the inflation rate. Like now, the interest rate in US is around 5, inflation is around 2.5. So, you have a real yield of around 2.5. It's
That's
different on
what
this.
the significance of real means in this context.
Yeah. It means you get actual yield accounted for inflation. you
Okay.
know. So typically and historically, when real yields were positive, it would be very bad for gold in dollar terms because it would mean that gold is competing with US Treasuries, and gold is not yielding anything. It's a piece of metal, right? So typically, gold would be sold off while real rates are going up. It didn't happen in 22. Like if you look at the chart, it's obvious it didn't happen. And this particular chart shows a real rate of it calculates it in a different way a little bit, but it's the same kind of idea.
So in the chart, when you're saying that, it's clear that it didn't happen in 2020, is that what you're saying? Is that
22,
22,
22.
sorry. Is that
So,
what would you
so
expect to
the
see in the case that they're selling off gold, like you're mentioning?
so the blue line is the real rates, right?
Okay.
And the white line is the gold price. They have different scales on the left and on the right. So normally, if you have the blue line going up, meaning that U.S. Treasuries give you actual yield accounted for inflation, gold would fall, and you see this in previous periods, right? But it didn't happen this time, and it should have happened,
I see. Yeah.
right?
Yeah. So
And
we're seeing this blue line continuing up.
well, the blue line again, it's the real rates, and the white
Okay.
line is the gold price. So the white line should have been going down, but it's
Ah,
going
yeah.
up,
Sorry. Yeah. Yeah. Yeah.
right? And the reason for this is because basically treasuries starting to compete with gold or the other way around for the status of reserve collateral. There's a lot of misunderstanding in this sense because like when people talk about the reserve status of the dollar, of the American dollar, they typically refer to the amount of trade being done in dollars and we pay for oil in dollars, all this. But the treasury market is actually the important part of this equation because it's actually the collateral that you hold and use in a system where US dollar is centric. To me, this break of correlation means that we're basically shifting from US Treasuries as the main reserve to gold. And it's critical, right? Because it has a lot of implications for the price of gold, at least, but also for the usage of gold. Yeah, and it's nothing to do with AI, but it's very critical. And I think the reason why this happened was because because of the freezing of Russian central bank's reserves after the war started, right? Because for guys like Saudis or Chinese or Brazilians or whoever, it meant that it could happen to them too. And instead of trusting the US that it won't, they just quietly and they started quietly moving to gold as a collateral reserve.
Mm.
So, these things have major implications. And also, gold typically goes up when people like me sniff out the increase in monetary base, the amount of paper money. And I think that's exactly what's happening right now as well. We're just doomed to see an increase in paper issuance.
Okay.
And that has implications for stocks, I think, and as a subcategory for AI.
But it's I have to admit it's well, I mean, look, you don't need someone sitting here listening to you to talk, say that it's a very complicated web, but even as you spell it out here, there's so many moving parts, isn't there, to understand
Yeah,
everything in the markets, and that what you're touching on
it's
there
true.
about the pivot to gold is very interesting as well, you know.
Yeah, I have different kind of acquaintances. I like talking to people. Some of them are like astrophysicists, and that stopped doing whatever they were doing professionally, rocket science basically, and tried to do something in the markets. And they and like this one guy in particular, he said, I tried to analyze it, and this is a rocket scientist that we're talking about, like proper one. And I tried analyzing the markets, and I realized very quickly that there are just too many moving parts
Too
to
many
this
variables.
equation, too many variables, and it's mind-boggling kind of thing. I have two kind of comparisons of what the markets are. One is the ocean. I love the analogy of the ocean because it can be quiet, it can be awful. You can have storms and things like that. And you kind of have to navigate your boat. You kind of have to build your boat and navigate it and get to the destination point. And another one is the chessboard. It's like a chessboard hanging in space, revolving all the time. And unlike chess, the real game, you get pieces added to the board, pieces taken away, extra layers being added. It's not static, to say the least, especially with all these, like if you go into market data and try to understand the econometric side of it, it just gets crazy detailed. And I don't advise anyone to do this, but it is a complex kind of thing. Yes.
Yeah, yeah, yeah. I was just thinking there when you're describing it, you're talking about oceans and water and going back to my own background in this computational fluid dynamics, just an analogy. There's a term in computational fluid dynamics, and it's one of the most complex terms in order to describe how water moves. It's called this
Yeah.
Navier-Stokes equation.
Mm.
And it's this really long equation, lots of variables and numbers in it. And if you can solve the equation, you can basically predict how water moves, because everything up until that point, we're just trying to estimate how water moves, because you never really know how when you hold you put water in your palm or in your hand and you try and hold it, you don't know what way it moves. So these equations are like incredibly complicated to actually get an exact prediction of how water moves. And I think there's like a 2 million, probably gone up because of inflation, a prize of 2 million for anyone that can actually solve this equation. They have the
Mm.
most advanced supercomputers in the world trying to resolve it, and they said that no one's done it, of
Failing.
course, But maybe thinking about the markets here as you describe it, maybe people would be better off trying to solve that equation than trying to solve the markets equation, with all the variables that come with that in itself.
Yeah, probably. Look, I'm not saying that I have the equation solved. I think there's no such thing. I think you just have to adapt to what's happening and like stay humble in your views.
Judge it, yeah. Try and get a judge on where things are going.
Yeah, yeah, it's an ongoing process. It's the moment when you say to yourself, "Oh, I've got it figured out." That's the moment when you're doomed, right? So yeah, but I still think, like on a basic level, without going into all these super kind of detailed ideas, the concepts are pretty simple. I mean, the dollar thing is pretty simple. The transition to gold is kind of self-evident. We're hitting all-time highs daily these days. So there are reasons why it's happening, and well, I've touched on some of them, but there are more. So I still think people should look into it, and I think, like, even if you are concentrated on, say, tech, you understand all these new inventions and stuff like that. I still think you have to understand the macro setup and where we are, where we headed. And it's actually what we do. We try to identify these big macro trends and kind of go down and find actionable ideas, whether it would be some sort of data instrument or an equity stake or a position in gold or silver or something like that. So this is my approach. It's not for everyone, I guess, but that's what we do.
Yeah, very interesting. Very interesting description.
I'd love to
Um,
hear what you think about tech and AI. Let's do that.
yeah, well, this was part of the this podcast. We were going to branch into this subject, probably a degree of my interest getting washed into our program here. But yeah, I mean, of all the ones that are hard to judge and to figure out where things are going, it's probably AI is probably the most hyped up and most booming market right now that there is. You know, we mentioned that you turn on Bloomberg or you turn on CNBC or you listen to anyone. You know, it's even funny. You get a taxi here in Ireland now, and sometimes people will mention AI and things like that. You know, which is a sign
Yeah.
of something that's really branched outside of
It's a
the.
pretty bad sign, Cormac.
It's
There's
funny
this
because.
famous, you know, sorry to interrupt. There's this famous story about the shoe cleaner and stock trader in the during the Great Depression. Well, in the days ahead of the depression, and basically this guy, I can't remember his name. I think his last name was Kennedy. I'm not sure. He went to clean his shoes, right? And the shoe cleaner was giving him tips on stocks, and some of the tips were his holdings of stocks. So he went and sold it all out straight away.
Yeah. Well,
Mm.
look, that's a more recent example. You know, I remember when I was growing up in the mid 2000s there, I remember in Ireland and globally, the property was the big thing, right? And it was everyone wanting to get rich off of buying property in largely in Eastern Europe, to be honest, you know. And
Mm.
it was just funny that I remember my father and other people used to be saying that, you know, when people in supermarkets and taxi drivers and, you know, even the most common, you know, anyone on the street is talking about property, which was what was going on at the time, the 2000s. It was a bad sign because you know, there's a lot of people trading on the hype, you know. So I mean, it's not to say it's the same with AI at the moment because as a concept and as a technology, it certainly has its wings, but it's just funny how much people are talking about it at the moment and how discussed it is. You know, again, just another analogy. Even last night, I was at a little community event here in where I live in Dublin, and it was for garden planters, you know. It was a
Hmm.
community event. So someone had gone around looking at um at houses and looking at the planters outside the front of the houses and judging them for like a little prizes. And I was sitting in this thing for in place of my father and got talking to this guy and he was you know, he worked in retail before and he now is studying product design. But, you know, within like 10 minutes, the discussion started branching into AI. So here am I sitting in this community hall in Dublin with a whole lot of people a lot older than I was, half of them focused on planters and gardening. And then here I am talking to a guy that brought up the concept of AI. And I just was laughing at it. I was saying, you know, this has really grasped the imagination of a lot of people. But I guess it's just useful before we go further on it. It's like you know, AI and all this stuff has been growing since the 20, when would it be, 2013, 2014 onwards, you know, when Facebook started taking off and big data started becoming a thing. And there's always been this version of you know, this machine learning, which is teaching programs to to optimize and I guess become more efficient in how they do their calculations and come up with conclusions. But in the last, I don't know, it must be 4 or 5 years, the whole AI sphere has started to accelerate, you know, and people have become more invested and interested in it and captivated by it. And that's largely due to, you know, the culmination of data and the amount of big data that is out there because Facebook is collecting our data and Google's collecting our data and you know, there's so much information there. So now they're trying to train these models to think like humans, which is what essentially, you know, AI is. It's no longer just about optimization of programs, which is what machine learning was, but it's now like they want these computers to think like humans. And that comes with its own problems, but we're definitely in a big hype cycle, definitely a lot about it because people are very excited about the idea of computers doing the thinking of humans. And yeah, so it's a very interesting market. I know, Paul, yourself, you're maybe a little bit more, I wouldn't say skeptical, but a little bit more nervous of the technology.
Yeah, I don't think skeptical kind of is the right word. I think it's a great tool, and it's definitely going to stay with us, and we'll see advancements in this. The problem I have is the monetizing of it. I don't see, in current applications at least, I don't see how you can monetize this. I've had a conversation with a client recently, and this guy. He's a very successful kind of tech entrepreneur, I would say. His company, they build these music instruments like synthesizers, modular synthesizers, stuff like that, drum machines. He's involved in chips and stuff like that. And he asked me, like, do I see applications in finance of AI or machine learning or whatever? And I had a thought about this, and I have to say, I see a lot of attempts to do something, but I don't see any actual, applications that could be monetized. And I mean, things like chatbots, they're not about monetization. They're about saving costs, maybe, but you don't make money out of it, right? You just save money because you don't need maybe a person doing the same thing.
Yeah.
I've seen some attempts to do some kind of big data analysis, also macro, but I wasn't impressed. Let's put it this way.
Mm. Yeah.
So, so yeah, there are obvious applications, like in translating, even music making, stuff that you can kind of limit, like when you have this chessboard that doesn't change, that the universe that doesn't change, like a musical composition. But when it comes to stuff like macro, for instance, you have to keep adapting the universe all the time. It's not static. So I'm kind of skeptical on that.
Yeah.
What I'm not skeptical about is NVDA results, right? We
Oh my
can
God.
we can actually bring up the chart. It's number 14, and it shows you the price chart of NVIDIA and the nice rally and some basic metrics like P and the balance sheet, right? So and if you look at the balance sheet, which is the bottom right chart, you can see how big a jump in net income, for instance, was. And these are yearly results, right? So you can see it jumping from 4 billion to almost 30, right? And the expectation is for further appreciation. So I'm not skeptical about that. They're selling a lot of them chips, right? The question I have is whether they'll continue doing so. And you can see like the gray areas for 25 and 26 are forecasts by some analysts, right? And you can see that it is forecasted that they will double their revenue, and double their profits next year.
Yeah.
So that's the question for me. It's a great company, obviously innovative, great CEO, everything. But is the market right about this? That it will keep growing. To me, it seems like one of those things where there's no competition, but I know there is competition for a fact, and it's not just US competition; it's global competition. For instance, every major Chinese tech company, be it ByteDance or Huawei or Xiaomi, all the big guys, they have programs working on this stuff, but also competitors in US as well. So I think NVIDIA is like the obvious beneficiary of this whole hype thing for good reasons, as we can see from this chart. But is it going to go on? That's the big question for me.
Yeah, I mean, I admit I did buy some NVIDIA before a few years ago, just because I had this expectation that when AI started grasping the imagination of everyone, that the whole thing would be a rising tide, to excuse the use of the term. But yeah, it's they're definitely so they're riding on, in my opinion, from trying to understand what's going on. They're riding on a huge amount of speculation and future thought, I guess, on it. I mean, someone I read there last week, someone described it as, laying down railroads, GPU capital expenditures like building railroads, and that eventually the trains will come, but there's no limit to the amount of land that the rail can be laid on. So the assumption that NVIDIA is trading on, and it's very interesting that you're highlighting there that the revenue is expected to double in 2025 and 2026 and so on, is the expectation that the money will return to companies that are trying to implement AI and trying to make it work and trying to use this technology. I share somewhat of a similar uncertainty with you about how does the money return for businesses, and how do companies make their money out of this, because I see that there's technological hurdles that I don't think have been crossed yet. I don't think we've even encountered any of them, to be honest, because there's been such a frenzy since 2023, last November, when ChatGPT suddenly exploded and everyone and their granny was using this model to write emails and to look up things and do all this stuff. And I feel like there's going to be hurdles for business and hurdles for the technology as well, which will slow down things. And I don't think I'm not certain myself if that's being priced into the way people are thinking. It's yeah, I mean, people are talking about bubbles. Is it a bubble? I don't know, but it's certainly there might be a bubble in terms of the application and the conversion to profit, because I think the technology is good, and I think there's a lot to be used in terms of automation and efficiency and improving how companies operate. But will that return to money is another question. For instance, just to touch on briefly, I was reading this survey that this company LucidWorks, they provide e-commerce and customer service stuff, and they ran this survey a few years ago, and they ran it again a few months ago, and they're long and short of it was they came to the conclusion that the honeymoon phase of AI is coming to an end. And what they did was they surveyed 1,000 companies in Asia, in USA, and across Europe. And in 2023, when they first ran the survey, 93% of companies were planning on spending big in terms of AI and trying to implement these technologies and push it. So when they ran the survey now this year, it's down to 63%. It's down 63%, yeah, currently 63%. And then on top of that, only 25% of the planned investment in generative AI that was supposed to be done is actually completed.
Mm.
So there seems to be just a bit of a slowdown in terms of the business end, and some of the reasons I believe that were cited were, there's barriers to entry, there's issues with security and accuracy. Like, what if these models are trained poorly? What if they're not being built well? What if there's an issue with the data that is, I don't know. Could there be an issue with security in terms of how these models are trained? You don't know, potentially. These are the kind of hurdles that are coming. And then keeping costs under control, there's the energy element to it. So a lot of companies may be a little bit more nervous about it. And then one interesting statistic off of that survey was that less than 15% success with implementation of analysis and optimization, monitoring, and so on. So that means that companies are using this, from what I can understand, as they're co-piloting or supplementary, I guess, to admin stuff, to HR, to generating facts and things like that. But when it comes to the actual analysis, or to the production end, the implementation hasn't been there yet. And that, in my opinion, from just reading it, will have this kind of gradual trickle back to companies like NVIDIA, as maybe there's a bit of a slowdown in how people use it. Whether that's a bubble that pops or not, That's another question. I don't fully know, but I definitely see this kind of slowdown. It could be on the horizon, you know?
Yeah, I tend to agree. I would like to point you to chart 26, which shows the ChatGPT website visits in millions, and it's clearly going down. So I would agree on the honeymoon phase being over. Just like any new thing, it's attracts people. People start using something, and it happens with every technology. It doesn't. I mean, this one is particularly fascinating, but it happens with every technology. You want your iPods, and then after 6 months, you can't stand it, right? Uh,
Yeah,
so
there definitely is a fascinating human study to be done on all this stuff. I'm sure there's some sort of what it would be, sociologist or kind of human behavior scientist that might have an actual insight on this stuff.
Uh,
But you
I
know,
think I think we have too many social scientists these days. Let's
yeah.
stick to maths and
Yeah, but
engineering and
it's even
finance.
even saw it reflected in some of the Bitcoin stuff during COVID. Like it was just again something that everyone flash in the pan is what we call it, right? Where it's like everyone suddenly took off with a lot of hype and retail investors in particular, and then
I wouldn't say it was sudden, In US, people were given money to spend away. Meme stocks would go up because there's just so much money. There was so much money flying around without too many, ways to spend it. So yeah, it was actually predictable. I think it was predictable. But in terms of technology, yeah, look, I'm pretty sure that this thing will keep going. It will keep developing, and we'll see these amazing applications. It's nothing to do with the market price, though. Just like it was obvious in 2000 that the internet is going to change the way we do commerce. It was obvious to everyone. Well, everyone in the field anyway, in finance and the actual internet companies. But it still didn't help the market because other things matter. It's not just the technology. It's actually getting it to be effective, getting it to be getting the technology to be monetized, and that's the difficult part. Again, it's easy for NVIDIA to monetize its chips. I mean, they're selling chips basically, but for a company that is coming up with solutions, it's a different proposition. And I think people are so used to free stuff that it's like all these fee-based models of monetization. I don't think they take into account the psychology of a human being, to be
yeah.
honest.
So you think that is that touching on the ChatGPT OpenAI funding changes, or are you touching on something?
Yeah, that's
Yeah.
part of it. They're talking about what, 2K a month subscription fees, stuff like this. I mean, I'm sure some people will pay,
God,
but
you would wonder what I mean, I suppose that is for their high-end models that they're proposing to come out, isn't there? There's two of them they're going with. It's Strawberry, I think is called one, and Orion is called another. And then I actually noticed today before coming on to chat to you that they have the reasoning model now launched, which is what is it called? ChatGPT O1, I think it's called, you know. So they're confusing people with the names. It's just like impossible to figure out which is which. But yeah, those high-end models, they seem to be thinking about changing the pricing because, I mean, from what I was reading again on their $25 per month model that they were running with ChatGPT 4, I think they were making a loss even, or they were cutting it close anyway, you know. So obviously they've had to decide that they're going to up the prices a bit to try and make a bit more money out of it. And that's a pretty, I mean, the ChatGPT and OpenAI are they're at the forefront of these large language models currently. You know,
hmm.
that is the frontier of it, and they're already struggling to maybe generate the money that they want out of it, you know. But
Yeah, it's a very capital intensive thing, right? For the adopters and for guys that are building the large language models. It's a lot of capital, and it's like one of those things, you realize it's big, just like the internet was big in early 2000s, but it's a question of timing more than whether the technology is
mm,
interesting and, capable of achieving certain things. It's just, is it priced right in the markets now? And I'm not sure. I think there are a lot of expectations built in already in the price. And I have my doubts as to whether they're priced right, basically, especially on top of all the other stuff that we've talked about in the beginning, all these problems in the economy. Because, like, at the end of the day, your consumer needs to have the money to spend on this stuff, whatever the stuff is. And this is not your basic need, right? ChatGPT or something like that. It's way out there, right? After your food and shelter and clothes and, getting your kid to school and things like that.
yeah,
So if we see a slowdown, a general kind of slowdown, and no kind of in your face money printing, like helicopter money printing reaction, I think spending on discretionary stuff like this is likely to go down, especially with valuations like this, So it's priced to perfection, basically. That's my view. And the world is not perfect. People overestimate themselves. So, including myself, by
mm.
the way.
No, of course
So
not. Of course not.
yeah. So yeah, I think there's like I think you've done a great job of getting into the stock early enough. That's key. Timing of this is key. You were smart enough to see this change, and you rode it. But right now, I would be very careful.
Yeah, I think that's a reflection of my own thoughts on it. And I mean, look, people did well on NVIDIA, but this didn't necessarily reflect for everyone because, at the same time, I was looking at, while we're talking about other companies, I was looking at Intel, for instance, and they were an interesting one also. It was, you would think a company like that would be primed to ride this wave of this AI hype, just like NVIDIA and AMD and Taiwan Semiconductor and so on, and all these various chip producers. But yeah, in Intel, for instance, I think in the last week they've gone down, I don't know, must be like 20% or something like
It's a
that. Or recently,
disaster,
it is a
that
disaster.
stock.
Yeah, it's a complete disaster, and it's very frustrating because they were primed, to go with everyone else, but it turns out they were just like not very
Productive.
operational savvy or something. So
Yeah, well, from my conversations with guys in the industry, Intel was a no-go for a long time. They were lagging behind for a long time. It's just the market is realizing this now, because they're basically saying it out loud. They have all these problems. Yeah, I think another thing to kind of consider is the concept, like if we're talking about the tax stocks, the Nasdaq of this whole thing, you have to consider the concentration of the index. You have these 10 companies or 7 companies or whatever that drive the market really. NVIDIA is one of them, obviously. And the other ones are also tech kind of giants, both in S&P and Nasdaq. And S&P is obviously a broader index, but still the weight is so big that if these companies move, they move the index. And the reason why it's important is because if you can assume that things not always go well, that these companies could, post a result that is not so good, for instance, it's likely to drag the totality of the index along with them. So it works both ways, to the upside and to the downside. And given that all of these guys are priced to perfection, that could add a layer of negativity if things go sour. They just kind of naturally drag other companies with them. And that's another reason to be worried. Uh, this podcast is turning into this doomsday kind
Yeah.
of scenario thing, right?
Falling tides rather than rising tides, right?
Well, depends how you positioned them, I'm
That's
guessing.
true.
I hope I'm positioned right for myself and my clients, but yeah, we'll see. So, yeah, anything else you wanted to cover on the? I guess we could talk about the global competition in this sense,
Yeah, well,
generally in tech.
that's exactly what I was going to say. That like you mentioned briefly there, that China, for instance, and I find it interesting reading about the global position on this stuff because a lot of it is being driven by NVIDIA and hype around NVIDIA and what they're producing, and then AMD or what they're coming along with. But there is still a market outside there which has a proportion, and I think it's like China, I think, is roughly around 30% of the global chip market in terms of production. And I mean, they've been hit with tariffs from the US, and I think some of the most stringent tariffs the Biden administration is proposing just to try and clamp down on them getting high-end chips, because the US want to slow them down. They don't want them, being at the cutting edge of this AI boom or the AI technology. So they've been slowed down a bit, but it's just interesting because they're coming along with you. You mentioned Huawei, like they're eating into this mid-tier of AI applications, and they're starting to push into, phone technology stuff. And there's a whole market in the middle there, which is not at the upper end, not at the
Hmm.
NVIDIA level, not at the AMD level, which will be attacked, I guess, or pushed into by these Chinese producers who are going to only get better at how they produce this technology.
Yeah.
So it's very interesting. And then meanwhile, the sad story is the EU and the Europe, because like, I saw a fantastic graph there during the week. I don't know if we have it in our slides that I don't think we do, but that, currently in terms of digital innovation, Europe is below Japan, and it is half, or not half, sorry, it's just about double South Korean digital innovation. So, we're not even talking about continents here when we're comparing EU digital innovation. We're comparing countries,
Hmm.
Japan and South Korea. And it's kind of tragic, that Europe is falling behind this stuff as well. And but it's interesting, this global market in terms of this stuff. The funny one I was reading as well, just to mention as well, was that NVIDIA, they use these 4 nanometer chips in what they design, and then they get them fabricated by someone else, like Taiwan
Hmm.
Semiconductor is a fabrication company that does the actual development of these chips. And then Apple, they use 3 nanometers. So these are really small chips that they're using. And Taiwan Semiconductor themselves are targeting now production of 2 nanometer chips. And obviously, the idea there is, the more chips you can fit into a smaller space, the more, efficient and the more powerful your chipsets will be. But I
Hmm.
just found it interesting there. I saw a few weeks ago that Russia started producing their own chips. And for context, in 1997, Intel were making their Pentium 2 processors, and they were at a chip size of 350 nanometers. So, NVIDIA are currently 4 nanometer. Intel Pentium 2 was 350 in 1997. Russia have now started producing it at 350 nanometer chips.
Yeah.
So they're about 30 years behind in terms of where these companies are. Now, they'll probably catch up a lot quicker because the technology is there. But I just thought it was a funny kind of story. But
Yeah, well, look, Russia, in terms of chip production, is the victim of globalization. Why would you set up your, local production when you can buy from anyone? And it's kind of the reason why China is lagging as well. Because why would you need your own lithographers if you can just go to Japanese or Dutch or whatever? That's what globalization was meant to be. You specialize in something and you kind of use your part in the global kind of delivery and production chains, right? Yeah, so I don't think you can compare Russia and China. I mean, these are very different countries. I don't know why Russians are producing these weird chips, old-time chips. Probably
Yeah,
military
probably.
use or
Yeah, yeah.
something. And actually, in military usage, they use a lot of old chips everywhere, also in US. I'm not a big specialist on that, but I know for a fact that all chips are used for whatever reason. So I think, like in terms of these tariff wars and trade wars and chip wars, I think they're counterproductive for the guys that put them in, right? So I think it actually pushed Chinese to develop their own kind of industry much, much faster than they would otherwise. And personally, I'm against all sanctions or tariffs or, all these kind of prohibitions. I believe in global markets, I believe you should have just open competition and the best guy wins kind of thing, right?
True free market kind
Yeah,
of idea. Yeah.
yeah, yeah. So we obviously don't have that, but I wish we did because it would lead to cheaper products and better products and better services and cheaper services. But, obviously you have every country has their own kind of security issues and all these things. But I don't know about like in the high end chips, China is lagging, obviously. It's not a secret. But the question is by how much, and I don't know enough about this. So when I don't know enough about something, I typically go to people that do.
Yeah.
And
Pretty good policy to have, to be honest, to
yeah,
be fair to you.
it's harder than you think,
Yeah.
than you would think, but yeah, it's a good policy. So I have some friends in the chips industry, guys that are actually designing chips and building these data kind of basically servers and the server farms and stuff like this. So pretty sophisticated guys. And they say that China is lagging, but it's going to catch up within years in the high end space.
Yeah, really. So they think they're gonna.
So yeah, I can't give you any details about the nanometers and all this. I'm just not an expert in this, but they say it's 1 to 3 years and they'll catch up. And I think the reason for this is because of the sanctions and because of these prohibitions. And actually, like it's funny. So one of the ways US tried to limit China's exposure to high-end chips was by, enforcing sanctions on guys who trade with them, right? But recently, so like it was especially important for lithography, right? And but recently they took away some of the countries from this, and in particular they took away Japan and the Netherlands. So it basically didn't work. That's
Yeah,
my read on this. It basically didn't work. The technology still got to Chinese, and you basically were ruining these businesses in Europe and Japan. So I don't think they work basically. In technology space, they don't work. They're counterproductive. And it just pushes China to do more, develop more, get their scientific base in order. Mm, you know, it's also interesting that China produces way more engineers and, data scientists than anyone these
yeah,
days. I mean, university level kind of guys. So, yeah, I think they'll catch up. I think the question is only how fast. I don't know. I trust my sources. I would say it's a couple of years,
yeah.
not long. I
So
don't believe Russia
where do
will
you
catch up.
where do you think, Paul, then the front is on this tech market and AI? Like, do you think there's something in your opinion that's still to be gained here from companies, or is there companies that you think do stand to make a bit of ground here? So we're kind of touching on China there, still have a they'll be eating into the middle market a bit more. But is there more, in your opinion, that you think might push into that?
Do you
Might become
mean,
competitive.
do you see like opportunities or
Yeah, I
what?
guess opportunities because I described to you before. I saw this useful chart recently. Again, I'm not sure we have it in the slide deck, but it's the bottom tier of a pyramid. So we have a pyramid, and the bottom tier of a pyramid is the infrastructure, and so it's like our NVDA and our Amazon and who else? There's Microsoft and there's these various other or AMD and so on, and they're producing these data centers and they're processing this data and setting up
Mm,
these AI models, and then you've got the middle layer, which is like the layer creating the models. It's the Microsoft invested in ChatGPT and OpenAI. There's, Elon Musk is coming along with his Grok AI now. He's trying to make that happen, and then there's a few more others. I know there's loads of people trying to come up with their own large language models, but there's this kind of middle tier where the AI models are happening, and then there's maybe a top tier, which is the kind of application end, which is like Adobe or I'm not sure what other companies are using AI right now in their business, but is there an opportunity front, in your opinion, on this stuff rather than it just being rather than us just being cautious, I guess.
well, it's a difficult question. There are always opportunities in the market. Whether I can identify them in the tech space, I wouldn't say I can at the moment, like these particular companies or something like that. So our approach is kind of this global approach. So for me, valuations matter a lot. So I like value stuff, I like stuff that is priced cheaply and pays a dividend and things like that if we're talking about equities. And we're not limited to, say, US market or China market or whatever. It's basically where I see the opportunity. And if you've asked me where I see the opportunity, it wouldn't be the tech side at the moment. One is valuations, as I've said, and another one is actually the steepener that I keep coming back to,
Going
right?
back to the steepener, yeah.
Yeah, the steepener. And the reason for this is because, your tech stocks, they by definition, they are long duration assets, It's a long story that you kind of have to envisage, how much money NVIDIA is going to make over the next, I don't know, 10 years, right? And then you take that number, you discount it by the prevailing rate, and you arrive at present value. That's the theory of it anyway. But the problem is, if I'm right about the steepen and the 10-year kind of stays where it is, and maybe even goes up, then you have to use that 10-year rate to discount to present value, which means that rates are going to stay relatively high for tech comparatively.
Mm.
So that would mean lower present values, right, than you would otherwise assume. So I think it's just not the best thing out there, in my view. I think there are other opportunities that could do better. But overall, I mean, our approach is like a balanced approach. We strive for balance. So it doesn't mean that you should not have any tech. It's just the proportion of it. How much do you have it and what kind of tech you have. We pretty much closed out all the big guys that we had, like, the Magnificent Seven stuff. We don't have any of that at the moment, but at some point we'll get back in. It's just not here. Or these companies have to start generating the kind of money that the market is expecting them to do. The worry for me is the macro picture, the global macro picture, and I think there are, just like with machine learning and AI, there are a lot of expectations built into the market that this easing cycle, that the lowering of the short-term rate will lead to this boom in investment. And given what I've said about the dollar and about gold and about changes that we see and all this and the competition, it's not set in stone. it might benefit some industries, but it might be very bad for others. So yeah, I can't say I have any insights into, the mid-tier or some applications. I can't advise anything, and also I cannot advise anything on a podcast like this because we're a regulated company. I have fiduciary responsibility. I can't give advice like that. Well, actually, I
Yeah,
can, but
that
then I
was
have to track it. I mean, it's
my effort in attempting to get a quick
to get me fined.
get you in trouble and get a quick get rich quick, get rich quick position. That was an effort there. Obviously, I failed.
Well, yeah, well, we'll see how it goes. Maybe next time we'll find something that type and talk about some particular companies that could be interesting. But I have to be very careful with this stuff. Basically, the rules say that I can give advice, but then I have to kind of track it and make it public, and tell people when I get out, all this stuff that I don't want to do. But yeah, we basically, approach it case by case and look at a particular company and see if we like it. And we and our clients, we invest in, I don't know, hundreds of companies probably. So, keeping track of the ones we have is hard enough. Looking for new ones, it has to be a pretty good idea for us to, spend time analyzing it.
Yeah, fair enough. Yes, understood. Yeah.
Yeah. All right. So look, I think we've talked a lot, and I guess it's enough for a first try. What do you think?
Yeah, I think so. I think we've covered a lot of information there, in fairness.
Yeah.
Yeah. So we'll have to, hopefully people listening will be able to parse some of it and
To wake up.
wake up and yeah. They have to tune right back into the middle when we were in deep in conversation. That's where all the juicy stuff and the get rich quick advice was. So they can't skip that,
Yeah. Yeah, once again, if anyone has any comments, ideas, or also in terms of how long this conversation is, we would love to hear from you guys, and so we can improve in the future. But I'm sure we'll do it again, right, Cormac? What do you
Yeah,
think?
absolutely. Yeah. And if nothing else, I'm learning a lot from this as well, getting so
I am
much
too.
information from you, Paul. So yeah, it's a
Yeah,
fantastic
that's
conversation.
great. That's
Yeah.
great. All right, man. Thanks a lot. Thanks to everyone. And let's see if we can keep this going.
Yeah. Thanks, Paul. Good luck.